Hi, Michael Yardney here, and welcome to another Ask the Experts webcast with my guest, Ken Race, Director of Metropole Wealth Advisory. Hello, Ken.
Hi, Michael.
Now, Ken, in the news we keep hearing a lot about the fact that Australians have taken on too much debt. There's a concern about the household debt that has accumulated over the last years. When interest rates have been lowered, people are borrowing to buy properties. They're maybe not saving as much. And so there's some concern that as interest rates go up, it may eventually cause some financial challenges for Australian consumers and the banks. What's your take on that?
Yeah, I think it starts off with, a lot of Australians now finally understanding that they have to be in control of their own financial destiny. And they've worked out that savings is just too hard because you've got to use after-tax dollars and it takes a long time to generate that wage. So debt has become then the instrument or the tool to help create that wealth because you can leverage it. And they've chosen an asset, property, which at least the banks like, and everybody needs a house to live in. So it's not an asset that maybe you want one day and not want another day. So they've taken those two considerations, borrowing to buy a bigger asset base and buying an asset that is actually always required.
So I guess what you're saying is to become wealthy, there's no choice. You have to have a level of leverage. And debt on its own is not bad. That came back from way back from Robert Kiyosaki about good and bad debt that we all read about. And we all know that there's good debt, which is against depreciating assets, bad debt, which is against depreciating assets, and maybe what some would call necessary debt against your home. But interestingly, when you look at the Australians in general, a third are renters, and so they're not ones who are taking on too much real estate debt. Of the 70-ish% people, just under 70% who own their own home, half of them don't even have a mortgage, so they're not in trouble. It really is those small percentage of over-leveraged investors or some first home buyers who are pushing the limits a bit. But Ken, in the last year or two, the banks have changed their serviceability criteria and they're more into responsible lending. So there probably isn't really a worry with that, is there?
I think by the time people, and most people have to pay a deposit, and in the majority of cases it's a cash deposit, so the actual exposure is actually much less than you would think. Because imagine if they borrow $80, they use 20 of their own money to buy a $100 asset. So that would mean that the asset would have to fall considerably before they were at risk of having to pay back the bank. So the banks have gone one step further, as you say, the responsible lending, particularly through APRA and the Reserve Bank pressuring the banks, because the government saw that keeping a lid on interest rates or reducing the interest rates actually spurred it on too much. So what they're doing is they're getting the banks to choke lending, and they're determining whether you can afford that debt using a much higher interest rate than you're actually paying. So they're actually creating that safety net to make sure that you can fund it even with a shock.
So they're doing what used to in the old days be called a stress test, make sure that you could cope with the stress of higher interest rates. Having said that, it's unlikely we're going to get significantly higher rates because APRA's getting its way anyway, and investors, I read somewhere recently, investors are listening to APRA. No, they're not. They don't actually want to listen to APRA, but they're being forced by APRA's restrictions to not be able to borrow as much because the banks are now making them pay principal and interest, not take as high loan to value ratios, and make sure that their serviceability is there. So on balance, then debt isn't a problem. What about savings? What's happening to the savings ratio of the average Australian household?
I think that's a very good question, Michael, because it showed that after the GFC, savings level grew substantially. And we're just seeing of late those savings levels coming down. But There are savings in many different ways, and I think that's the falsity of looking at that statistic. I mean, as your property value grows that you live in, that's considered savings. The 9.5% super guarantee that you're putting in is savings. But we're lucky that we've actually seen in the low interest environment, people actually paying off their debt a little bit faster to again cushion them in case the interest rates go up. But with, can I say, low inflation, low wage growth, we're actually seeing some Australians dip into their savings to pay for things that maybe they could have saved for or not bought. So we're actually seeing that suppression in the economy because people aren't spending as much money. But overall, because of increased immigration, we're seeing a lot more people in Australia than buying goods. So some of the shops are doing well because of migration numbers growing.
Now, I think one of the other points that's got to be made to put things in context is even though debt has increased significantly, interest rates have decreased significantly, so therefore people can carry more debt and still be able to afford it.
So if we take out the need for the deposit, let me give you this simple example. Imagine 10 years ago you borrow $500,000 to buy a property.
Typical house in Sydney, I guess, Ken, a $500,000 house.
500, yeah. And assume your interest rate was 10%. That means your annual interest rate is $50,000.
And boy, Ken, were we happy when our home loan rate was 10%? If it got under 10%, we were excited then.
Yeah, because at one stage it was 17%. Yeah. So imagine you fast forward and you now have to pay $1 million for that same property, but your interest rate is 5%. So now your interest rate, 5% on $1 million, is still the $50,000, but your wages have gone up. The cost of a lot of other items such as travel, home goods has come down. So the carrying cost of that interest in real terms is less today than it was some time ago. Sure. So the issue is you just got to make sure that you've got risk mitigation strategies in place to continue funding that bank debt.
So I guess in summary, having debt's not a problem, and all those people who are worried about household debt's not a problem, as long as it's well managed. So you manage it well by owning the right assets, and as you said a moment ago, Ken, real estate's the right asset, so if you buy the right sort, it isn't very volatile, and it's unlikely to drop more than 5% or so over the next little while when the market eventually turns. And you've got to have the right financial buffers in place to see you through if interest rates go up. And I guess you've got to have the right asset protection mechanisms in place too, Ken.
That's right. And it's really just that tick boxes, the right asset, the right structure, risk mitigation for the interest rates, which is the buffer, and you use debt to, if you like, fast track your wealth creation using other people's money as opposed to your own, which is very hard to accumulate given tax rates.
Just too hard to save your way to wealth. So thanks, Ken. Debt is good as long as it's good debt managed correctly. Thanks for your time, Ken.
Thank you, Michael.